Well, Mark and Maria, I'm really glad that we've discovered this opportunity to work together and really improve your overall financial well-being. And you guys have done a great job so far. And again, the fact that you're making this commitment to working on and improving your financial household picture it means a lot to see. It's part of why I love what I do. And today I also wanted to focus a little bit more on the investments component of your plan as well. That was one of the areas you guys have done very well in, but then also one of the areas that I think we can most tangibly improve. And talking a little bit about investing in general within the scope of financial planning and retirement planning in particular, utilizing investments is one of the most important ways to help households realize their long-term financial goals and get to the point where they're comfortable with their asset level and income planning, approaching retirement and moving into retirement and beyond. And a few of those fundamentals that we talk about with investing are concepts such as asset allocation, diversification, and rebalancing. And before we even get to those topics, another one of the most important pillars or fundamentals of investing is having an emergency fund. So being able to step up and fill the need of an unexpected financial calamitous event, maybe something like a car repair, all the way through much more serious things that households face, maybe things like health issues or incapacity and troublesome events. So having an emergency fund, usually 3 to 6 months of capital on hand, is the first step of being financially comfortable to bridge the gap and move into investments. And then from there we talk about asset allocation, diversification, and rebalancing over time, and also within the scope of a time frame or a life cycle of investing. So when we talk about asset allocation, that mix of stocks and bonds is kind of the most direct way, or the way that people hear about it the most. But within that, that can also be looked at as a risk tolerance. Stocks, a more aggressive, more risky asset class. Bonds, the contrary to that, a more conservative asset and designed to sort of mitigate volatility of growth assets or more risky assets. And across the spectrum of assets and asset allocation, you may hear things like commodities or alternatives or real estate, and those all play a big role in the next level of investment planning, which is diversification, having the right mix of assets within those asset classes. Diversification really does work over time to mitigate volatility, as well as to sort of zig when other things zag, or work well in tandem to grow your assets over time. So having the right mix of assets with asset allocation, being properly diversified within those asset classes, which can mean different things at different times based on economic factors, and then also again tying the idea of your time frame in that we keep talking about, and I'll mention again in a minute. And then lastly, rebalancing, or keeping the target mix in mind. As markets move up and down, those values will change. Those different pockets of an investment portfolio will change. And we want to be constantly monitoring, rebalancing, keeping those different asset classes and investment exposures in line with your risk tolerance and time frames as you move through your investing career. So all that comes together and allows us to sort of identify two phases of investment planning or an investment life cycle. You may hear the terms accumulation phase or distribution phase. The idea that the further you are from retirement, you're in an accumulation phase where you want to be doing your best to grow assets. The idea that the longer time frame you have, the more risk you can afford to take. And then as you move through your investment career, your investment life cycle, and your accumulation phase, and come closer to retirement or using the funds, we call that the distribution phase. So the longer time you have and the more accumulation opportunities you have, the more risk you can afford to take, ignoring day-to-day movements or volatility, and keeping the eye on the long term. And as you move into that distribution phase or become closer to your retirement or your goal of using the funds, periodically addressing your risk level and likely mitigating risk or drawing down your risk exposure as you move towards retirement, and then of course through retirement as well. And that's a little bit about helping folks understand an idea of what an appropriate risk level is. It's going to, of course, vary individual to individual, but it's a really important fundamental part of long-term investment planning that I like to outline with my clients. And also lets us touch a little bit on the concept of behavioral finance, or how you can sort of identify the right behaviors with your money. Money is inherently sensitive and can be an emotional topic, as it should be. We don't want money to be the driver of everything in life, but obviously in our society it's important for so many reasons. And when we look at studies or look at household accounts or retail accounts, a lot of times people can behave rashly, and what you want to do is kind of use this framework to help you identify maybe what this experience can be like over time, and allowing through your own experiences, and of course working with a professional and the investment professionals in my community as well, that we can make sure you have the right behaviors over time, that you can follow this framework over time, and that goes tremendously far in attaining the success with your investments and moving into your retirement goals. And moving away from sort of those fundamental frameworks, we'll always be talking about this as, again, we're monitoring your investments over time, and as we continue to meet and grow our relationship. But for today, there were a few things that stood out to me with your investment exposure that I thought we could highlight as a good jumping off point in some of the most immediate recommendations that I would make for you. The first was Maria's life insurance proceeds. I know maybe we could gather more info to see what that exposure looks like, but from what I can see based on sort of the economic environment, what we've experienced in the past, and what our forecasts are for the immediate future, I think there's an opportunity to improve your investment exposure. Maybe really dial in what that should look like, and maybe that's rearranging some of the existing securities or investments within that portfolio, or potentially changing them entirely if they weren't suitable or appropriate for you. But I do think we can do better with that portfolio. It's a sizable sum of money, and is a really important component or sort of pocket of all the saving and investment planning that you guys have been doing so far. And second, Mark, your brokerage account had a few things that stood out to me. There's a large treasury exposure in there, very, very conservative securities in there, and again, we want to look at how that might fit in the holistic exposure that you have, or maybe it is something that you can reallocate to potentially improve performance if it's maybe a little bit too conservative for you, given your time frame, about 17 years until retirement, and your moderate aggressive risk tolerance that we'd be comfortable with, and that we can talk about more going forward. Another thing that stood out was some of the options exposure you have in there. I always like when my clients are interested in investing. It's obviously something that I have a passion for as well. And options are a fairly sophisticated strategy, and I want to maybe talk through that or get a level of your understanding, make sure you're comfortable with your exposure there, and whether that's something you can handle yourself or something we can help you with, or maybe that's worth changing. But that stood out to me as well. And lastly, some of your emerging market growth exposure in there. Back to the idea of diversification, international and part of that being emerging markets is, historically always an important part of a portfolio. But when we look at the broader picture of your investment exposure, that seems to be a fairly stark overweight within the account. Maybe that's something that warrants adjustment as well. So those were some of the immediate things I noticed that we could spend some time on with your investment exposure. And again, utilizing these sort of fundamental principles that are proven to work over time in our stock market and bond market and broader investment markets. And again, I'm really appreciative of us being able to work together and explore these opportunities to improve your financial well-being going forward. Thank you.